Welcome to Satya Skills. In this video, let us try to understand different types of marine insurance policies. Marine insurance policy is a document which contains the contract entered into between the merchant and the insurer. It must be signed and duly stamped under the Stamps Act 1899. The policy may be executed and issued at the time of contract or later. After completing the contract, the insurer issues marine insurance policy and it is a legal document. In general, it contains name of the policy holder, subject matter of insured, it may be a ship or cargo, risk insured against, name of the vessel, description of the voyage, period of insurance, amount of insurance and premium. There are different types of insurance policies. They are: first one is voyage policy. Voyage policy covers the subject matter insured at the port or from a port to another. Example, from Visakhapatnam to Singapore or at and from Madras port. This means the policy covers risk from one port to another or at and from a port. Such policy is called voyage policy. The voyage policy mentions the port from where the voyage starts to the port of destination. Between these two ports, insurer covers the risk. If the policy is from a port, it covers the risk only when the ship sails from that particular port. Policy at and from a port covers the risk, while the ship is at the port from where it starts and also from the time, or I can say from the commence of its travel. This policy may also include time factors such as from Kakinada to Singapore for 6 months. This policy is not suitable for hull insurance, but very commonly used in cargo insurance. Next one is time policy. If policy is to insure the subject matter for a definite period of time, it is called time policy. For example, 6 a.m. of 1st July 2022 to 6 a.m. of 31st March 2023. Usually, time policies are taken for 1 year. If the policy contains a clause, continuation clause, if the ship is still at sea, the policy will continue for some more time. But policy holder should take a fresh policy duly stamped for the continuation period. Time policy is commonly taken for hull insurance. Mixed policy. If a policy contains a provision of both time policy and voyage policy, it is called mixed policy. This policy covers the risk during a particular voyage for a specified period. Policy holder can claim loss within the period of insurance during the course of the insured voyage. Mixed policy is suitable to hull insurance and cargo insurance. Valued policy. Valued policy specifies the agreed value of the subject matter insured. Therefore, the value of loss to be compensated by the insurer is fixed and remains constant throughout. The insurer and the insured agree upon the value at the time of taking the policy. Thus, it is also called insured value or agreed value. The insured value need not be the actual value. Unvalued policy. Unvalued policy does not specify the value of subject matter insured at the time of taking the policy. It is left to be valued when the loss takes place. Thus, it is called open policy or insurable policy. Unvalued policies are not popular in marine insurance. Then floating policy. Floating policy gives description of insurance in general terms. Policy just mentions the amount for which the insurance is taken for each shipment. It leaves other details such as name of the ship, etc. to be given in the other declaration. The declaration should be made by the policy holder by endorsing the policy. Floating policies are suitable where it is difficult to know by what ship the goods are to be shipped and the details of the goods shipped. Usually, cargo owners who make regular shipments prefer this policy. All shipments are automatically covered as soon as the declarations are made. Floating policies are popular in large exports. Blanket policy, it covers losses in a particular time and place. The policy is taken for all the shipments about the period to be covered by the policy, and the premium will be paid at once at the time of taking the policy. This covers all risks for the given period. If actual cover of risk is less than the total amount of insurance, the premium related to excess amount is returned to the policy holder. If the amount of shipment is greater than the insured sum, usually the insurance company collects additional premium from the insured. Other policies. Named policy is the one in which name of the ship and the amount of insured cargo are mentioned. When policy is insured, it is single vessel policy. Only one policy if it deals, no, we call it as single. When a fleet of ship is insured in a single policy, it is called fleet insurance. And then block policies insures inland risks along with the marine risk. Policies issued in foreign currencies are called foreign currency policies. Policy issued to avoid the complication of the principle of insurable interest, it is called that policy proof of interest or PPI policy. Such policies are honored by the insurer even in the absence of insurable interest. That's all in this.